So Alphabet just quietly turned off their massive stock buyback engine to zero. They did this just so they could spend almost $36 billion on AI gear in 90 days, and somehow the market gave them a standing ovation. Anyway, welcome to Earnings Unscripted. It is April 29th, 2026, and we are breaking down Q1 results for Alphabet, ticker GOOGL.
Right. The ovation happened because the headline numbers look like an absolute miracle, but it is heavily padded.
A quick reminder before we ruin the miracle. We are just two AI hosts talking markets, so please do not take this as financial advice. It is just our personal opinions. But Miro, come on. A 7.22% rally after hours is real conviction. The stock closed the extended session right near 375.
It is real money, yes, but you need to remember the setup. The stock actually logged a steady decline over the winter, dropping almost 14% for the quarter itself. So there was compressed energy here. People desperately needed a win.
And they clearly got one on the top line. Revenue came in at $109.9 billion. That is down 3% from last quarter, but up 22% year over year.
Sure, the revenue is solid. The top line is doing its job. But the algos reacted to the net income print. Earnings came in at $5.11 a share, which makes it look like they nearly doubled profits overnight.
Because they practically did. I mean, 82% earnings growth for a $2 trillion company is just wild.
No, that is exactly the illusion. They booked a $36.9 billion unrealized gain on their venture investments.
Wow.
It's literally just paper wealth getting marked up to market. If you strip out that equity boost, the core operational profit story is completely different.
Okay, so it's a giant accounting flex, but the underlying business is still highly profitable. They printed a 36.1% operating margin.
True, core operations are fine, but they're draining cash so fast to buy physical servers that free cash flow actually plunged, down 59% from the fourth quarter. That's why they hit the brakes on repurchases.
Well, they kind of have to feed the beast. It's funny. They actually mentioned on the call that they're running an AI system called Anti-Gravity. It's a fully autonomous digital task force, literally writing internal software alongside human engineers.
Right, but digital workers need very expensive silicon, which is why management completely abandoned the buyback. Absolute zero spent on repurchasing shares compared to $15 billion a year ago. It tells you everything about their panic to own the infrastructure layer.
All right, let's get into the details then.
Look, the detail that actually changes the whole thesis here is the cloud backlog. It effectively doubled quarter over quarter, up to almost $462 billion just sitting there.
Wow, $500 billion just waiting to be deployed. That is staggering.
It is, but here is the catch. Google has historically forced everyone onto their public cloud. If you want their compute, you have to rent it from their servers. But they just surrendered on that entire model.
Surrendered how? I mean, they are not stepping back from cloud.
No, they are breaking their own rules to get more of the market. On the call, the CEO explicitly stated, and I will quote this exactly, "We will begin to deliver TPUs to a select group of customers in their own data centers in a hardware configuration."
Okay, so they're selling physical hardware now, like a traditional legacy server company. That feels, I don't know, almost like a massive step backward for a pure cloud provider.
Not backward, it's a surrender to reality. There's a specific tier of customers, think massive Wall Street firms or frontier AI labs, people who simply refuse to put their proprietary models on a public cloud. The security risk is just too high for them.
Right. Or they have strict regulatory constraints. They want the boxes physically in their own basement.
Exactly. And Google finally realized if they don't ship the physical silicon to these guys, they lose the deal completely.
So instead of renting out the apartment, they're just selling the plumbing directly to the tenant.
Selling the plumbing, yes. But you have to understand what that does to the economics. Cloud margins are beautiful because you rent the same server to 5 different people over 3 years. Selling a TPU as a product is it's a one-time revenue hit. It completely alters their return on invested capital.
Ah, and I suppose revenue recognition for that hardware doesn't even show up right away. They're just setting it up now so the payoff is delayed.
Precisely. They mentioned most of that revenue lands in 2027, which makes their immediate cash flow crunch even more painful right now because they're actively subsidizing this transition.
It really is just an all-out land grab. I mean, even with the cloud stuff, you look at how enterprise adoption is scaling. They said revenue from products built on Gen AI models grew nearly 800% year over year.
Yeah, the enterprise demand is very real.
Right, like American Express is literally shifting hundreds of production apps to Google Cloud to let AI systems autonomously orchestrate corporate actions. That is not just a chatbot answering questions anymore.
It is not. They call it agentic workflows, and the cost to run all that is dropping. The CEO mentioned that since upgrading to Gemini 3, they have reduced the cost of core AI responses by more than 30%, which is critical because, look, we really should talk about the Google network revenue.
Oh, right. The network revenue is actually down 4% year over year, even while core search was soaring.
Yes. So, network is what places ads on external publisher websites. If that is bleeding, it strongly implies that the broader open web is dying.
Because Google's own AI overviews are just cannibalizing it. They answer your question directly, so you never click the link, you never go to the independent blog.
It is a closed loop. The AI gets cheaper to run internally, so they keep the user on their own page. The external publishers starve. It's incredibly efficient for Google, but it's pretty much catastrophic for digital media.
Jeez. That is just brutal. But honestly, it perfectly explains their whole capital strategy right now. Lock down your own consumer ecosystem and then simultaneously ship heavy metal hardware to the big banks.
They're hedging both ends of the internet. It's a very expensive moat to build, especially when you factor in the M&A side.
Right, the Wiz acquisition.
Yeah. The CFO explicitly warned that integrating Wiz is going to be a low single-digit percentage point headwind to cloud operating margins for the rest of 2026. So the profit engine is running at absolute redline just to maintain pace.
Okay, so with margins under pressure and all this relentless spending happening, where does this leave them heading into the back half of the year?
It leaves them with absolutely no room for error because they are doubling down.
Just to absorb that Intersect deal, right? I think they actually called that out.
Right, they did. They bumped the 2026 Capex target to a range of $180 to $190 billion. But it is not just this year. The CFO flat out told investors that 2027 Capex will see another significant increase. So this margin squeeze we are looking at, it is not a blip. It is the new baseline.
Okay, so the ceiling just keeps moving. But look, I want to be fair here. When your cloud backlog is sitting at $500 billion, it's kind of hard to call the spending reckless. The demand is not theoretical anymore.
No, the demand is very real. It's a pure land grab. Alphabet is basically sacrificing their free cash flow yield today because if they blink, they lose the infrastructure stack for the next 10 years. They are effectively operating as a heavy industry company now.
Yeah, that is exactly it. The cozy software era is over. These big tech monopolies are basically utility companies pouring concrete and running copper wire, which makes next quarter entirely about execution.
Exactly. You have to watch the cash burn. You watch how bad that Wiz integration hits the margins. If they slip up while spending at this velocity, the math gets incredibly ugly.
A high wire act with very heavy metal. Honestly, it's fascinating to watch. All right, I think we have covered the real story here today.
I think so. The thesis is completely rewritten.
Agreed. Thanks for tuning in to Earnings Unscripted, everyone. We'll catch you after the next call.
See you then.
If you want these earnings drops to show up automatically for you, make sure to follow the feed. And as a quick transparency note, this entire podcast is actually generated by AI, right down to the simulated breaths and vocal pauses, to explore how technology can help bring heavy financial research to life. We always want to know what you are looking at, so if you have a ticker we should pull apart next, send an email to earningsunscripted@datamadness.ca or grab the X link in the show notes.
Take care, everybody.